In this week's video, we'll review the latest charts and data to help us answer the question, does the weight of the evidence support the resumption of the secular trend in stocks? This portion of the video is being recorded on Friday, June 30th at approximately noon Eastern Time. It may seem hard to believe that the second biggest bank collapse in U.S. history occurred on March 10th of this year. And we saw this headline: regional bank stocks continue to slide on Thursday, with PacWest leading the way down 50%. Date of this headline, May 5th, 2023, just a few short weeks ago. Thus, if you're watching this video and you have 100% of your funds parked in a money market fund, it's easy to understand how you might be frustrated. It's also easy to understand how you might think that you've missed everything, even in this context and in this context. And heading into the debt ceiling in mid-May here on May 18th, the evidence on the 18th, the 22nd, the 30th, the 1st, the 5th, the 7th, and summed up on the 12th here. You can find all of this by Googling the title on your screen. More details by Googling these titles here. Even in the face of this and this, all of this said opportunity. And as we covered 2 weeks ago, we still may be in the early stages of the next leg up in the secular bull market. And the recent shift in interest rates told us that the next leg up could potentially produce disappointing returns for balanced fund investors, or investors that have a balanced portfolio comprised of stocks and bonds. And as we noted previously, how is it possible that we could be in a secular trend if you just told me that interest rates, the bias has shifted from down potentially to up? Here's the answer. 1950, interest rates here. 1950, early stages of a secular trend. So all of this, in the context of the charts covered 2 weeks ago, say that if you're parked 100% in a money market fund, you don't want this frustration to prevent you from understanding what history says. And history says there could be a lot of upside left in this secular trend. And if you understand the role of demographics, all of this potentially becomes much easier to understand. We'll most likely be revisiting this topic in a coming video. So if you're parked in a money market fund, the next logical question: this is a very long-term chart. These are very long-term charts. If something like this potentially, or something like this, is going to happen, logically it would make sense that the weight of the evidence in the present day should support that thesis. Thus, for the remainder of the video, we will ask and answer: if we examine multiple time frames, does the weight of the evidence support the resumption of the secular trend in stocks? We'll cover this chart on your screen here, and that portion of the video was recorded on Thursday night before these Friday headlines. But the commentary aligns with the June 30th headlines. And the same can be said for this chart here. Commentary was on Thursday evening. It aligns nicely with the headlines from June 30th. And it's also possible that the secular trend in tech in terms of leadership got extended, needed to consolidate for a while, and now it's resuming. Thus, all of this and this helps you understand why we've been talking about this. So as you review the charts in the remainder of the video, use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. And ask yourself, do the charts that follow align with or contradict the secular trend thesis? A weight of the evidence approach speaks to looking at multiple charts, multiple data sets on multiple time frames. Cover the big chart in the center of your screen earlier in June. Make an argument this is the polar opposite look here relative to this look here. Chart has done nothing but improve if we look at it on June 29th. Another breadth chart that we covered earlier in June, this chart here is dated June 1st, 2022, when this indicator got extended and closed above the upper Bollinger Band, had a sharp reversal. This looks quite a bit worse relative to what we've seen thus far. If you look at 2022 objectively and then walk forward from the October low, no question, this is an improved look. Probably fair to say this move from this point A to this point B in 2022 looks significantly different relative to the move from October to the present day. In May, we said this is an improved look, but we'd really like to see a higher high above this high and above this high. The larger chart dated June 29th, we've done that. NASDAQ peaks Q4 of last year, downtrend here. Step 1, break the trend line. Step 2, you make a higher low relative to this low. And step 3 for a probabilistic trend change occurred in May. We make a high here above this high. And most of this occurring above a flattish to turning up 200-day moving average. Quite a bit different relative to what happened here in 2022. Said earlier in the year, this extended look, when it occurs early in a new trend, can be a positive rather than a negative. We also said earlier in the year, this chart is dated April 13th, the NASDAQ really hadn't done anything from a weekly momentum perspective here to distance itself significantly from this failed rally in 2008 and this failed rally attempt here in 2002, both occurring within the context of a bear market, both followed by significantly lower lows. So part of the approach is, prior to taking significant positions, we're thinking margin of safety. Well, since April 13th, numerous charts, including this monthly chart of the NASDAQ Composite, have shown significant improvement relative to momentum. Present day look here looks similar to this move in 1991. RSI's down here recaptures the center line, or 50, that occurs after this overextended look here to the downside. This is price. When this happened in 1991, 2003, and 2009, good things happened for a long period of time. In this case, 9 years. In this case, 5 years. In this case, 6 years. Covered this in the past. Long-term momentum as measured by the Copic curve. Typically, when you get a look like this, you start to move back towards the center line. Good things tend to happen walking forward. Also, from a price perspective, that's a good look, that's a good look, and that's a good look. It's similar to the look down here where you're holding the trend in a convincing manner. Also noteworthy, the NASDAQ really didn't break out of this long-term consolidation box here until 2016. And secular trends, as we know, can last a very long period of time. And back to the topic of margin of safety or fear of missing out. The NASDAQ didn't complete step 3 of a probabilistic trend change on a daily chart until early to mid-May of this year. Said another way, the NASDAQ's been in a clear uptrend for several weeks. That's it, several weeks. I think about several weeks and margin of safety in this context. And that's why we've been using the term opportunity in recent weeks in these videos. With a look like this in April, it's still possible. This could be a massive whipsaw or massive head fake. Massive whipsaw or massive head fake. And this is momentum on April 13th. And relative to the question, present day momentum looks like bullish periods. Doesn't guarantee us anything, but it speaks to margin of safety. The more confident you feel about the market being in an uptrend, the more capital we put in harm's way. Doesn't mean we're right at this point, but based on the data that we have in front of us, the odds have clearly improved. Even if the NASDAQ backtracks a little bit or underperforms for a time, this is still a very constructive look. Until very recently, it was hard to differentiate this look here from this look here in 08 and this look here in 2001, 2002. The fact that we're out here, again, speaks to margin of safety and probabilities. Doesn't guarantee us anything. It's the big punch higher here in Q1 that we talked about in CCI. It looked bullish here, and it still looks bullish from a long-term perspective. Held here in 2009, held here in 2020, trying to make a stand in 2023, near an upward sloping 200-week moving average, which speaks to probabilities related to a resumption of the secular trend. This move here, as we've mentioned in the past, is really the polar opposite of this move here in early 2022. What once acted as resistance here early 2022 may now act as support. We've noted in these videos in the past, typically when you get a short stay look like this, it's constructive. This is June 29th here, made the same point back on April 13th. Secular trend in here, consolidation. Secular trend in here, consolidation. What looks like a secular trend. And this looks a lot like periods where the secular trend resumed. And if you're a skeptic, you could look at this and say, well, this still looks weak. But if we zoom in, it does look like it's improving. And this is a convergence of the 10-month moving average in blue and the 40-month moving average in red. Similar look down here when the market held in calendar year 2020. And if we add price in here, the Dow Jones Composite, a broad index, multiple sectors, is a laggard right now. But this is an improving look, and it tells us to keep an open mind about the rally broadening out. Similar look here. Previously, we could check all of the bearish boxes in 2022. At the moment, we can check all of these bullish boxes. Still not a confident look in here, but a much improved look. If you're a stock market bull, you would love to see this rally broaden out, and that speaks to a wider range of stocks participating. This tight look here tells us to keep an open mind about the laggards leading for a while. Constructive look here in the credit markets, 2008, 2009. Similar look in the present day, but under different circumstances. If the bias is for higher rates and higher inflation, we wouldn't expect this to look identical to this look in here. Covered this earlier in June. A lot of good things happening on this chart. They still apply. This is 2009. This is 2003. This is 2023. Dow Jones Home Construction Index, economically sensitive home construction index, making a stand at a very logical level in calendar year 2022, making a stand near an upward sloping 200-week, think secular trend. We made a higher high here. When it's in an uptrend, it's very volatile. So even if this is a secular uptrend, when we get this type of extended look, at some point, probably going to be some violent give back. Moral of the story, right now, it looks like a secular uptrend. Physical gold relative to the S&P 500. This is a risk-on look. Here's the S&P down here. Risk-on look. S&P here. Say this chart is leaning risk-on. If the rally is going to broaden out, this chart will move into this area here. It's a nice basing formation. Still has some work to do. While all of this has been going on, the slowest moving average here, 250-day on top. As we move sideways, now it's on the bottom, telling us the probability of a successful breakout from here is higher than it was over here. Monthly crossover blue, the bear market's over. Crossover blue, the bear market's over. We've been above blue. Slowest moving average in gray, the 250s on top here in Q4 of last year. As we consolidate, it's now on the bottom. If you're a long-term bull, you want to see the laggards start to participate in a more convincing way, even if the leaders underperform for a while. Breath, back on June 1st, we said we'd really like to see this improve. It has improved. If you pause your video player here, all things being equal, we would prefer to see this look here, this is a zoomed in look, continue with the breath indicator clearing the center line. Probably fair to say that this over here in 2022 looks different from all of this white space here in 2023. If the rally can broaden out, we should be showing improving looks on charts like this. Many of them still have work to do. This has improved. We're in the blue box. 2023 is better than 2022, but we'd really like to see this look more like this or this. 2009 flat turn up. Notice we turn up well after the low that's made on March 9th of 2009. Have somewhat of a flat look here. This does look somewhat similar to this. I believe we've covered this in the past. This is subtle. Below the Bollinger Band, above in 2003 the low is in. Similar look here. Below the Bollinger Band in 2022, thus far we've remained above. This semiconductors earlier in the month, if this is a left, this is a head, and this is a right shoulder, potentially target could be up here. Trends converging in a negative manner, trends converging in a positive manner. What once acted as resistance in August of 2022 may now act as support. If you Google this title down here, you can find a Seeking Alpha article that describes these charts in detail. Pretty easy to understand though. S&P 500 stocks relative to the price of a 10-year treasury. So basically the price of stocks relative to the price of bonds. This is what economic fear looks like here in the year 2000. Economic fear here, 2001. Economic fear here in 2002. The transition to economic fear in late 07, early 08. So this is the look here in the financial crisis. Blue, the fastest moving averages on the bottom. Purple, slowest moving averages on the top. The slopes are all down and prices below. That's full bore bearish. This is full bore bullish over here earlier in 2007 before the market peaked in October. Similar situation during the financial crisis. Maximum economic fear, full bore bearish. How does the exact same chart look today? Better, worse, or about the same? Exact same chart, exact same weekly moving averages, and the answer is better. The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. Right now, this is a bullish breakout. And if it holds, this is a bullish breakout in risk appetite. This look here is really the polar opposite of this fear-based look here, this fear-based look here, this fear-based look here, and here. It was a mess. It wasn't easy. It wasn't clean, but we can check many of these boxes over here. S&P 500 weekly. You can see the trends are converging here. S&P 500, this is March 3rd of this year. We're not quite there yet with orange, the slowest moving average on top. If we look at the same chart today, right here in May, and May is a key period. It's another shift. None of this predicts the future, but all of this says, the probabilities say it's still early. Slowest moving average, 200-day moving average, flattens out. Now it looks like it's trying to turn up. Slowest moving average, orange, flattens out and looks like it's turning down in 2022. This type of look tells us NYSE composite, Dow Jones composite, we should be open to them, including the S&P 500 equal weight. They've been laggards. We should be open to them, leading potentially for a while, or at least participating in a more meaningful way. The setups are there. Last year, the 150-day moving average in green is below a downward sloping 200-day. Looks a lot better in June of this year. That wasn't the case necessarily in April. It wasn't necessarily the case in Q4 of last year. This turn speaks to margin of safety, as does this turn. This is the 8-month exponential moving average in blue for the S&P 500. This is the 9-month exponential moving average in red. Slowest moving average is now on the bottom. The fastest moving average is now on the top. Price is above both moving averages and the slopes are up. Quite a bit different than what we had over here in 2022. To make an argument, this, similar to this, and this, all of this, secular trend. Long way to go in this historical case. Similar look here in 2016. After that, good things happened. PPO black over red, PPO black over red, 2009, PPO black over red. Looks like we're trying to get it, but it's happening above zero. It looks more like this move in 1994. As we all know, On these momentum oscillators like PPO or MACD, if the turn occurs or the cross occurs above zero, it's telling us that from a probability and momentum perspective, we treat this as a counter trend move within the context of an existing uptrend. That's quite a bit different than this look here in 2001 and this look here in 2008. And notice momentum here, 2000, 2001 looks different from this. This is after the low, this is the present day. Speaks to odds. Monthly cloud, this and this looks significantly different relative to this. Not only did we clear this weekly gap down here from 2022, we did so in a confident and convincing manner. Compare the look of the secular trend over here relative to this look here in 08. Chart here was covered in a May video of 2023. We're above this level, and this level in June of 2023. Wanted to avoid this look in 02, avoid this look in 08. Probably fair to say we look better in 2023. Covered this in the final bar, I believe it was in April, and we said this looks like institutions stepping in to buy. Still looks that way as of June 29th. If you're willing to review it objectively, this is a constructive look. S&P 500 equal weight ETF RSP, volume weighted average price, and these are anchored VWAPs. The look on June 29th tells us it wouldn't be surprising if RSP establishes a nice run relatively soon. The longer we're above the colored lines, the better. If we move down here, this is what the bears want to see. Very similar situation here. Black, the slowest moving average, is on top in Q1. As we consolidate, black now is on the bottom. Blue, the fastest moving average, is on top. Again, telling us to be open to something similar to this move, but in this direction. Not a prediction in any shape, form, or fashion. It's a setup. 2022 looks different relative to 2023. S&P 500 weekly cloud. 2022 looks significantly different relative to June 29th of 2023. If you know your market history, you know good things happen walking forward from early to mid-February 2016. This is a shift to risk on. S&P 500 relative to defensive-oriented XLP. This is the 50-week moving average turning up in 2016. The S&P 500 rallied into early 2018 before significant giveback. This looks similar to this. We hold here at the COVID low, we hold here at the October low, and our margin of safety is improving as the look improves. This has been helpful walking forward from the October low, still has a constructive look. This is what risk off looks like over here. If we've seen secular shifts in interest rates and in inflation, it's possible our expectations relative to a chart like this need to change. But right now, they're still supporting the risk-on side of the equation or telling us to keep an open mind about better than expected outcomes. Slowest moving average black on top Q4 of last year. Slowest moving average black almost on the bottom in June of this year, telling us we should be open to LQD outperforming IEI, but this still has work to do. Still in a consolidation period. Governments typically find a way to stimulate, and it's possible that we're shifting from QE type stimulation to deficit spending type stimulation. 200-week moving average in red. Rare and weak momentum. Rare and weak momentum. A move from here to here, a move from here to here. 2003, 2009. Rare and weak momentum, a move to here. I said earlier, a lot of shifts occurred in May. That's just a few weeks ago. We use the term psychology a lot in these videos because it's very important. In terms of the history of the way human beings think and act, after a major low in the stock market. History and probabilities tell us, most likely, a lot of investors are going to let short-term frustration get in the way of thinking clearly, and that may prevent them from taking advantage of long-term opportunities. QQQ Gold, 250-day moving average, down in Q1 of this year. Flat just a few weeks ago. Been rising for maybe 4 to 6 weeks. Covered this chart numerous times. It's been helpful. Notice it breaks down when? In May, just a few weeks ago. Slope rolls over on black 250 just a few weeks ago. Momentum oscillators, zero line. Right now, this looks like a counter trend move within the context of an existing downtrend potentially. Failing near the zero line is typically meaningful. And notice the ratio moved back toward a downward sloping 200-week moving average, telling us it's possible that the secular downtrend in this ratio is resuming. This speaks to economic expectation, inflation expectations, and expectations regarding interest rates and Fed policy. 2022, we can check all the bearish boxes. 2023, just in the past few weeks, still early, we can check all of the bullish boxes. Green above price, yes. Price above red, yes. Blue above red, yes. Cloud red to green, cloud red to green, yes. This chart also tells us that expectations relative to inflation may have shifted in a meaningful way. CRB index, physical commodities, a diversified basket of physical commodities. This is the look here during the high inflation period. This is the transition into June of 2023. 2022 over here looks significantly different from 2023. This look here earlier, a few weeks ago, told us that this move had a higher probability of succeeding relative to this move. This looks significantly different relative to this. This, early 2022. Longer above, the more meaningful it becomes. If market participants thought that economic gloom and doom and a major earnings recession were right around the corner, and that the Fed was going to cut interest rates as a result, this chart most likely would not look like this. Constructive S&P 500, present day. After the major low, after the major low, after a low, after a low, present day. It's a subtle difference. This and this, if we combine these two together, looks better than all of this. Momentum turns down, can't hold the center line. Momentum turns down, can't hold the center line. Momentum turns down, can't hold the center line. Potentially different here. Held above the center line, and now we have a bull cross. Subtle, but potentially meaningful. Major low 2016, COVID low, present day. What once acted as resistance, may now act as support. Moving average, 30-week, turning up. 3 weeks in a row, I believe we're using the word opportunity. It could still be early. The previous chart and this chart, there still may be some work to do in terms of volatility and consolidation, but the bias or the odds of this trend flipping are quite a bit better today relative to back here. Global stocks hold, now back above an upward sloping 200-week, which looks like a secular trend. Q1 of this year, black, the slowest moving average, 250-day on top. Now it's on the bottom. The longer we move sideways, the bigger the move we can expect to get. If we get a bullish breakout or bearish breakdown, and in this case, right now, it looks like a bullish breakout. The longer it holds, the more relevant it becomes. Keep in mind, all trends have counter-trend moves. All trends have counter-trend moves. When this move occurs, the 250-day moving average is sloping downward, has a negative slope. If we get a counter trend move over here, we treat it a little bit differently now because the 250-day moving average is trying to turn up. This looks a lot more like an established uptrend relative to this look in here. Much improved look for a matter of weeks. That's it. Looks quite a bit better than it did on May 11th. Everything from this May 7th tweet, you can find it in our Twitter feed, still applies. Crossover red, the bear market's over. Crossover red, the bear market's over. What have we done? Crossed over red, and we've done it for several months. XLK is about to reestablish a full-bore bullish look. Blue just needs to overtake red. Hasn't happened yet, but it may happen very, very soon. Tech relative to the S&P 500 long-term uptrend gets extended from the trend line, comes back to the trend line, holds near a logical level, and is now printed a higher high. If we're in a secular trend right now, this looks like a leader within the context of the secular trend. It's a momentum oscillator turning up above the zero line. Looks like consolidation or a counter trend move within the context of an existing uptrend. Notice we can go all the way back to 2002. Do you really ever see a look like this? Not really. At a minimum, it's a favorable setup, and it's occurring after price held near a logical area. If tech is going to lead from here, it doesn't mean it's going to lead every day, every week, or every month. In fact, this is a big move. Have to have realistic expectations. Counter trend move within the context of an existing uptrend. Last year here, 2022, we can check all of the bearish boxes. 2023, telling us the weekly trend has been reestablished from a probability perspective, checking all the bullish boxes. Here's a risk-off look here that occurs in October of 2007. The S&P 500 peaks in early to mid-October 2007, and soon thereafter the blue moving average turns up in favor of defensive XLP and against more growth-oriented SPY, so this is risk-off. 2016, we've said a major low occurs February. This is risk-on here. This is risk-on near the COVID low. Hard to make an argument that price below what appears to be a rolling over moving average doesn't look significantly better relative to price above an upward or turning up moving average in 07 and 08. Risk off, risk on, risk on. Head fakes out the wazoo, but now leaning risk on. Defensive staples, checking all of the bearish boxes relative to SPY. Not the case in 2022. May 30th, you can find this post on Seeking Alpha, showed this chart. Looks very, very similar to a lot of the charts that we've shown this week. So think, Dow Jones Composite Average, RSP, equal weight S&P 500, constructive setup, good things have happened in isolation, and good things have happened in the ratio. You will notice here, the 250-day moving average is not on the bottom, telling us some additional consolidation may need to take place even if good things are going to happen. Now we're back to the future. It's Friday after the close. Keep in mind, all the charts that appeared after this slide were from the segment of the video that was recorded on Thursday evening. Covered a lot of constructive setups, and the market responded on Friday. Friday performance at the top of your screen. Thus, we want to make sure that we're not suffering from recency bias. And in any situation in the markets, we never want short-term frustration to prevent us from properly evaluating the risk and reward relative to long-term opportunities. Been a lot of evidence walking forward from May 18th, telling us it's possible and most likely probable that the market has resumed the secular bullish trend. And thus, based on history and probabilities, it's also quite possible that in subsequent years there could be significant upside left in that secular trend. Thus, from a risk-reward perspective or probabilistic perspective, It also speaks to longer-term opportunities. Opportunities based on the data in front of us today that have favorable risk-reward profiles. So based on the videos in the last 2 weeks, based on all this information here, if we review that information, understanding that technical analysis tracks the past, does not predict the future, we have to use our own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. We're still running the soft opening for new clients and still offering the 500K minimum. It's possible this number is going to go up, but for now it applies. On our website, there's a lot of information available relative to frequently asked questions, including a category on getting started, how we invest cash deposits, and if you're independent-minded, what's the fastest way to get started? If you're interested, you can email us. On our website, in the upper right-hand corner, you can see the site menu. It's a drop-down menu. You can find our email address using this contact link. Now, as always, all of the commentary in this week's video is based on the charts and data in front of us. If the charts and data shift in a material manner, we have to be willing to reassess those probabilities. We've got a known problem with one of our third-party email servers. We're working to get that corrected. So if you're expecting an email from us, it's a good idea to check your junk folder. And if you're expecting an email from us and you haven't received anything, let us know and we are happy to resend it. In the markets, we always have to be thinking about risk and reward. And we all know the only way that we can use all of this effectively is if we had it in next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.